Hi, David here, CEO and founder of the Freedom Founders Mastermind community. A lot of people ask me, David, what should I do about my investments, especially like my retirement account investments? We've seen this really long wave secular cycle going back to 1980, where we've had lowering of interest rates down to the bottom at July 2021, where interest rates really hit a historical 7,000 year low. Where do we go from here in the market cycle? Well, I say we're going to a new secular cycle for a lot of reasons I could go into detail, but essentially we've had subsidized artificial interest rates thanks to the Federal Reserve, monetary policy, the government, Congress, fiscal policy, which has just flooded our country, our citizens with fiat currency. And we also have this huge, now monstrous sovereign debt ball, over $31.5 trillion, unfunded liabilities, over $100 trillion, and it never ends. So when people say this time is different, meaning that, well, the Federal Reserve can keep kicking the can down the road and we'll continue to see growth and buy the dip and the stock market's down, but it's going to go back up and crypto is going to go back to, $100,000 or whatever they think it's going to do. I say, hold on, hold your horses. Nobody knows exactly what's going to happen. I certainly don't know, but I would hedge my bets if I was going to hedge, and I do hedge, on the side that we're going to have more of what we saw in the 70s. Stagflation, meaning high inflation, particularly consumer price inflation, which we certainly have big time right now. Yeah, the CPI, the government says it's coming down a little bit, but still at 6.4% based on last month's CPI report. You've got at least double that number because they manipulate the number. So we're probably running at least 12 or 13% at a minimum. Add that to the fact that we've had the greatest interest rate rise by the Federal Reserve to try to fight inflation that we've seen really in history. In less than 12 months, we've gone from 0 basis to almost 5%. In fact, we'll be at close to 5% by next month. That's a massive rise. You can't put that big of interest rate rise against the debt that this country has and say it's all going to continue. Something will break. I can't tell you what, I can't tell you when. So what do? You hedge against what's the greatest downside risk that you have. I think today it's in expecting continued growth, this extrapolative growth that we've seen in all sectors, financial markets, being stock market. We've seen it in real estate. We've seen it in business multiples because of all the cheap money we've had for so many years. That money is running out. That money's running out. Yeah, all that money, the trillions of dollars, the unprecedented amount of money that the Federal Reserve and Congress pumped into the economy during COVID particularly, but even going back to the 2008 great financial crisis, this money has a devaluation to it, which means that prices go up. Prices go up. Now we're in a deflationary period where the higher interest rates, the higher cost of capital, and the decrease in liquidity, the credit markets, the financial markets eventually will tighten, if not seize up completely. We've seen this in past cycles. And that's going to be the continued downfall of equity valuations across the board. I don't care if you're talking about stock market, real estate, or your own business or dental practice, if that's what you're in. We're going to see a decrease. Now, what does that mean we have to do today? In our investments or our business, we have to look back to the fundamentals, merit-based investing or merit-based business models, where we're talking about operational efficiencies. Yeah, we haven't had to do that for a long time, right? Why? Because there's always a greater fool who would buy whatever you held, business investments, at a higher price because the money's cheap. It goes on and on. That's stopped. The lag effect of what's happened in the last year is only starting to catch up to us now. I totally expect to see a greater devaluation of equity assets, disinflation, deflation, whatever you call it, maybe recession, depression, you name it. I think that's where we're headed. So there is going to be a strong dip, more of a valley, more of a trench that I think we're going to see. And that's where the opportunity comes up. So if you stay investing and building your business like you have for the quick exit, the high profits, it's all worked in the past. I don't think it's going to be there. I would just be careful. Hedge, put some money there if that's where you like to play. But I'm keeping more money in higher liquidity elements today. Safer place. Maybe I don't get the returns I was getting 2, 3, 4, 5, 6 years ago, but I know I can make upward on the other side. That's what you do when you become a sophisticated investor. How do you do that? Do you need to go to school and get an MBA and get degrees in finance or real estate or whatever? You can. I think there's a faster way. I think you get connected to groups of people that have already gone down that path and are bringing the opportunities, discussing the opportunities, vetting the opportunities as a group, and having the access points to those opportunities as they come up. You don't get that out on Wall Street. You don't get that out in the major markets where retail investors really aren't going to have a place to play, in my opinion. That's the key to your future success. You've got to become a more sophisticated investor. It's going to be prudent for you to do that for your own longevity, for your own legacy, and maybe something you teach your kids as well, because the whole marketplace has been distorted. The incentives have been perverted for too many years. It's going to be very, very tough for some people, but those who are positioned well will do very well. You can trust me on that.